In this video, I'm going to put on a simulated trade in the Qs so we can see that the Iron Condor method taught in this course could work even when the conditions are not optimal. So right now I hear people talking about it's not the right time to trade Iron Condors. You should be buying options, not selling options. The market's too choppy, you're getting whipsawed and your position's under attack. So what we're going to do is we're just going to put on a position and manage it through this type of market and see how we do. And I'm not saying that you should take the worst conditions all the time, but if you can learn how to manage the trade during the tough times, when the times are easy, this strategy will pay off in a big way for you. So I'm going to go out to May, and I'm going to use my expected move of about $8.50. And I'm going to subtract that from the 184.50 here, and I'm going to look to sell the 176. So if I scroll down here and if I sell the 176, and then I'm going to do $2 wide, so it'll be 176, 174, and I'm getting 29 cents. Then I'm going to go on the call side. If I add $8.50, we're looking at about 193. So I come up to 193 here. And I'm going to sell another vertical here and switch that to 195. So I'm getting 58 cents total, and let's take a look at what that looks like in the picture. And I'm just doing 5 contracts of each. So my risk is 715, and then my max reward is 290. Now, since the market's been on a tear to the upside, what I like to do with this strategy is buy an extra call or do something to smooth out this risk picture, the pink line, so that I don't have to worry about it. I'm not always sitting in front of the computer or wanting to have to deal with the trade. I want to set an alert at some extreme level, maybe 3 to 5 points away, and if that level gets hit, then I want to be notified. But otherwise, the day-to-day fluctuations, I don't want to have to worry about. So if I add an additional 195 call, let's see what that would do to the picture. And I'll just do one of these. So I'm going to knock it down to 1. And they're going for 37 cents each. So if I come back to the picture, notice how that brings up the upside line to where if the market went on a tear 5 points, 6 points, I'm really not in any pain here. And if the market went on a tear to the downside, I have here's 5 points down. I'm down $50, $60. So I have some room before I have to make an adjustment. I like this trade. Is it the best time to put it on based on blowing past expected moves and all of that? No. But we never know which week the market's going to blow past the expected move and which week it's going to stay put, or over a series of weeks. So I'm doing this for May. I'm not doing it on a weekly option. So we should have enough time to manage the trade unless overnight we get like a $10 drop. But let's say the worst thing happened. You got a $10 drop, then you're past what your max loss would be. But if you look in history of how often that has happened, it just hardly ever happens. So you want to protect yourself from that, but the chances of that happening are very small. I'm protecting myself from what the normal is and being aware of what the largest problem could be. And if the market did start tearing off to the downside, what I can do is I can buy a put that will pull this curve around and give me much less risk to the downside and perhaps even make some money. So I'm going to lock in this trade. We had 5 contracts of the put side, 5 contracts of the call side, and 1 additional call at the 195 strike. And we'll monitor it during the life of the trade and see how it does. So let's check in on our Iron Condor trade on the Qs from just about 2 weeks ago. Even though the conditions weren't ideal, we put the trade on and we want to just see how this strategy works and see if we can manage the trade during some challenging times so we can use this on a regular basis. Now right now the trade is showing a profit of about $55, and that's because the market has moved a little bit higher, but it has pretty much gone sideways or stayed in our range or underneath our window of 193 down to 176. Now, of course, there's more time left, but what we've been doing is just waiting for the time decay, and over the past 2 weeks, The time decay has increased to about $5.50 a day based on our current price location. and we're just making income per day. And we have a little bit of a cushion here, especially to the downside right now. We would prefer the market to go down, but we are also at a point where we have to decide, is the market going higher from here? Has anything changed? Do we need to do something to give us a little more room or a little more cushion on this side right now? Or are we comfortable with where we are? Maybe we just set an alert up at the 190 level and let us know when the price gets there, and then maybe we make an adjustment. So let me bring the chart in for a second. And if you notice, over the last approximately 2 weeks of trading, the Qs has stayed between about 183 and 188. And we are up near all-time highs. We actually took out all-time highs intraday during the week. And we're back down to where we're right about equivalent to what the high was over here. Now, if we were to break out above this 188 level, would that change your mind and make you say to yourself, well, I think we're going to continue rallying. It looks like we're breaking out above that level, and maybe a neutral trade where I think the market's going sideways is not going to work out. And if that's the case, you would have to decide, do I either take the trade off, or is there some type of an adjustment I can make that could allow me to stay in the trade without really risking hardly anything? So let's move this out of the way. And right now on our risk picture, it shows me that we are reasonably comfortable. If I came all the way up to 192, I'd be down $55. But right now I'm up $55, so I don't know if I want to give that back. Would it be worth spending some of this credit up here? And right now that credit, if we look in the bottom left, is about, the max is 257. Could I spend some of that credit to make this trade give me a little more comfort zone on the call side? So what I've done is I've pre-built a couple of sample adjustments down here, and these are current live data adjustments. And one of them would be to buy a 191 over here and then sell another 193. So we already have sold the 193, 195. But buying the 191, 193 would give us a little bit of a bump here, and it would start to flatten out this line. So if I was to check this one off, and we would just do one contract, but if I check it off, we're going to watch what our theta value is over here, and we're going to watch what happens to our delta value. Notice delta is minus 18, meaning we want the market to go down. But to take the pressure off, we would need to lower that number without hurting our theta too much. So if I check that off, notice I went down to near minus 8, so that I'm not going to be in as much pain as quickly. And notice the zero level here is way up at 192 almost. And I've flattened out the line to where it's much more comfortable, and I still have plenty of room to the downside, or at least enough time to react to it. And that's what we're looking for. We're looking to not be surprised. So this is one choice adjustment that does okay, and it drops the theta from about a 5 to a 4.4. So it's 550 to 4.4. The delta went from minus 18 to about minus 8. And let's look at a couple other choices. If I was to just buy a call, what would that do to my theta and my delta here? Let's say I bought one call. That would cost me less. Instead of it costing 60 cents or $60 of my credit, it would only cost 36. So let's take a look at that one. And notice how that one flattens out the line too. The problem with that one is it brings my theta even lower. So because this is a long call, if the market were to start screaming higher and really took off, I could actually come out with a profit somewhere in this region and say to myself, you know, this isn't doing what I expected, let's just bail out. Or maybe you hold on to see if it continues before it winds up dropping into this valley of death as time passes. Because once you're outside this zone, time is not your friend anymore. Where when we're inside here, time is our friend. The long call would be a good choice if we thought the market was going to be screaming higher. Maybe that would be something we do if it's breaking out above the highs and we want to try and stay in the trade. And the other choice would be to just close out of one of the 193, 195. So when we initially put the trade on, we sold 5 of these at 30 cents. And right now we can buy one back for 36 cents. And it's true that we're giving up 6 cents on this, but what are we doing to the picture is what we're trying to figure out. And if I do that, it does give me a little bit of room, not quite as much as doing the 191, 193, but that one costs more. And this still leaves me a 221 max credit. So you would have to decide on the chart, do you want to do something now? Do you want to wait till it breaks out? If you remember, we come over here, maybe you just hold off and have your adjustment ready, and if it breaks above here, the 188 level, then you put on the adjustment, and as long as it stays put under the 188 level, then maybe you hold off. Now the problem with waiting till the last second to make an adjustment is that if we get a gap up $1 or $2 or $3 above this level, say tomorrow morning or another day later in the week, especially since Amazon's reporting earnings and Facebook is reporting earnings this week, Microsoft, we easily could have a possibility where we get a pretty good bounce up. So because of that, maybe you want to be proactive and sacrifice a little of the credit just to give yourself some more room. But don't go crazy so you don't leave yourself vulnerable on the downside. So let's come back here. And let's say, for argument's sake, we're not sure if Amazon's earnings are going to make the market scream higher and break out. So what if we actually went up and did 2 of these? We could buy back 2 of them. We're lessening the risk here. And we're trying to be cautious. We want to make some money, but we're willing to give up some of the credit just in case. But we still have about $6 room to the downside, and we have room now to the upside. And we can compare that to just doing one where we have a few dollars room, and we could even do this one. This one would work fine. But for this trade, what I'm going to do is I'm going to make believe that I'm afraid that the earnings are going to make the market break to new highs again. So I'm going to go with buying back 2 of these just to take some of the pressure off on that side. And if the market does start to tank, we'll make another adjustment on the way down or just exit the position, depending on what it looks like is going on.